In this video, we're going to cover the basics of stocks and bonds. Now, I wanted to make this video because I want to ensure that everybody kind of understands the basics before we move on to some of the more advanced financial topics. Stocks and bonds are a type of asset class, and asset classes are basically just a category of investments that have similar characteristics. So asset classes might be real estate, they might be precious metals, they could be derivatives, they could be currencies. But stocks and bonds in most portfolios are the most popular asset class. And stocks and bonds are also a major way that companies raise money. So let's talk through an example to show you how this works. Let's say a company wants to build a new factory. And this factory is going to cost them $500 million. Now they have a good business case to build this factory. If they build the factory, it will increase their capacity, they'll be able to build more products, they'll be able to sell more products, and they'll be able to generate more revenue. So the factory will have a high return on investment, which is a high ROI. Well, with this business case, the business can go out to the financial markets and raise money for this expansion. And they can do this by issuing stocks or bonds. And there's a couple of reasons they might do this. They may not have cash in the bank. They may not have the $500 lying around. Or they may just do this as a strategy. Let's talk a little bit more about the specifics of stocks and bonds. Stock is an ownership interest in the company. So when you own a stock, you're actually owning a percentage of that company. And you may have heard this term market capitalization. What market capitalization means is, depending on the price of stocks in the market, what does that inform us about the value, the perceived value of the company? So mathematically, you would take the share price times the number of outstanding shares. That should give you the perceived value of the company. So if you own 1% of the shares of the company, the value of your shares is the overall value of the company. 1% of that value should be how much someone's willing to pay you for those shares of stock. And I'll show you a diagram of how this works. You have the company. The company wants to issue stock, so they go to an investment bank. They issue stock for a certain percentage of the company. The investment bank gives them the funds, the $500 million for the factory. And once those stocks are issued, they can then be traded on the secondary market. And this is what most of us are familiar with, the buying and trading of stocks. This buying and trading activity sets the stock price from what people in the market think is the perceived value of the company. And that market price informs back on the company and dictates strategic decision making, and it impacts their ability to raise funds in the future. Now, bonds are a little bit different. Bonds are essentially debt. It's the company going out and getting a loan from the bank. So they'll actually set up an agreement with set interest and principal payments, and they'll raise the $500 million by saying, we'll give you this payment back over time. Once that loan document is set up, just like stock, those bonds can actually be traded in the market. And whoever holds that bond is the person who receives the interest payments. So let's move on to the major difference between stocks and bonds. The major difference is that stocks are riskier than bonds. And this is really the main takeaway. And there's two major reasons for this. When you have a bond, you have this set agreement and you have a set payment amount that you know you're going to make every month or every period. Stocks, you may or may not get paid. It's not a set payment. Stock is a percentage ownership, and so really that's a percentage of the profits, but the company may or may not make profits. They may make a small amount of profits or a large amount of profits. There's risk there that's not there in bonds. And even if the company makes profits, that's no guarantee that you'll receive them, because stockholders only receive profits when they're paid out as dividends. So, a typical scenario is a company will make a certain amount of net income or have a certain amount of cash flow. And the CEO will, look at that and say, well, let's look at our cash and we'll divvy it up. We'll put some of it in the bank, we'll pour some of it back into the company to invest in future growth, and then a portion of it will pay out as dividends. Well, that dividend payment then flows back to the shareholders. And depending on what percentage you own, that's the percentage you get of that dividend payment. So if you own 1% of stock, you'll get 1% of that overall amount that was paid out as dividends. So this allows you to participate in the upside or downside of the company. So if the company makes a lot of money, they'll have a larger dividend payment, you'll get more money, as opposed to bonds where it's a set payment amount. The other reason stocks are riskier than bonds is bankruptcy. When a company goes bankrupt, bondholders get priority over stockholders, because bondholders have this set agreement. They're going to be paid a set amount, and that agreement has to be fulfilled before stockholders get anything. So those are the two reasons why stocks are riskier than bonds. The reason why all of this is important is for managing investment portfolios. Because what you do when you manage an investment portfolio is usually you have this overall portfolio and you have a number of stocks and a number of bonds. And what you're trying to do is manage the risk of this portfolio. You want this portfolio to have a certain amount of risk. And so depending on that level, you can adjust the percentage of stocks and bonds. If you want a riskier portfolio, you could hold more stocks. If you want a less risky portfolio, you could hold more bonds. There's one other thing I want to touch on, and that is tax implications. And I always encourage all investors to consider the tax implications of their investments, because they can be pretty significant. For instance, if you sold a stock and you made an 8% gain, you need to not only understand that 8% gain, but what's going to happen after you take taxes out at the end of the year with that 8% gain. It's probably going to be less. So, and tax laws change every year. They're going to be different for individuals, for corporations, depending on how much money you make. So you really need to talk to your tax professional. But again, I encourage every investor to think about the tax implications of their investment decisions. And I'll give you a specific example. For individuals, right now there's a different tax rate for short-term capital gains versus long-term capital gains. This could impact your decision on your time horizons of your investments. And the government does this because they want to encourage long-term investment. So again, it's just an example of understanding your tax strategy when it comes to investments. So to recap, we talked about the basics of stocks and bonds. I gave a description of each and talked about the differences. And then we covered some tax implications.